So this is our agenda for today. I don't intend to go through all that list. I'll leave it there for you to have a look at, but we will cover all of these areas and explain how we can assist you in respect of each of those areas. Hopefully a bit introduction to St James's Place. St James's Place are a FTSE 100 company operating through a network of partner practices, of which there are 2,500 partner practices across the United Kingdom. And this is a little bit about Leicester Brunt. We were founded in 2013, the end of 2013. I've been with St James's Place since 1997, and we have a great amount of experience in dealing with families and clients, and long-term care is something that we get asked questions on a regular basis, and hence today's presentation. Ultimately, after today, you may well want to have further meetings to you, and I can be made available. I will be available to assist in any way that I can. So we will be able to help you achieve the goals that you're looking to achieve. So where are we today? Social care in England really goes back to the 1948 Healthcare for All from the NHS and the National Assistance Act of 1948. And we've had the last 30 years of attempted reforms, and we will cover towards the end of the presentation the reforms, the changes that we are expecting. But what is recognised is that the current system is inadequate, unfair, and not really fit for purpose. And whether you pay for care or whether care is paid for you is not as clear-cut and as easily understood as it should be. Doing some research for today's presentation, it was interesting to note that between March 21 and February 22, it was estimated that 360,000 homes, which occupied just under 78% of care beds. Of that group, 35%, just under 126,000, were residents that were self-funders, and the balance, some 235,000, which is 65%, were state-funded. And it is the cost of the state funding that has been the issue that has challenged all political parties. What was interesting is the figures for 2019 and 2020, there were 392,000 people in care. The sort of split between self-funders and state funders were about the same, but it was 85% of care beds were occupied. And I would put the difference down to COVID and the impact of the virus in regard to residents. One of the things that we talk about when speaking to clients is trying to prepare for eventualities in the future. And one of the most important things in regard to care is a power of attorney. You'll be aware that prior to 2007, we had an enduring power of attorney that was authority that you could give to someone to take. But these powers of attorney did not need to be registered until they were needed. And the government didn't like the fact that there was powers of attorney out there that they were unaware of. And so they introduced a new system post-2007 when they introduced lasting powers of attorney, and they split those into two areas. They had a health and welfare and a property and financial. So the property and financial will have been very much in line with the old enduring power of attorney, where you were giving authority people to take financial decisions on your behalf. And that would allow them to manage your money, make decisions on what you might do if you were selling your house and things like if that power of attorney came into force. But they also introduced a health and welfare power of attorney, and that is very relevant to long-term care. Because if you haven't provided a health and welfare, who chooses where you go for care is down more to the local authority than it might be for you or your family. So to maintain as much control as possible, it would be worthwhile considering having both a health and welfare and a property and financial power of attorney. The other aspect that we would often care was contemplated is a review of a client's will. And why is that important? We will come later to discuss what assets are assessed and what assets aren't assessed. What you would want to try and avoid, where possible, is with a married couple example, that let's imagine the husband is in care, the wife continues to live independently. If the wife was to die first, you might not want her estate to automatically pass directly to her husband. And of course, vice versa, is you may want to protect some of those assets from being assessed or being eroded through meeting the cost of care. So we would often discuss with clients what you might do with regard to the assets that each person owns in the event of the carer dying or the person in care dying on a first basis. Experience has taught us that people seek advice in one of three areas. Very rarely do we get that first box, which is well in advance of care requirements. However, that does happen, but it is less frequent. And I put that down to the fact that both individuals that might need care and families, it's a topic, it's a bit like death, it's a bit like reviewing wills. It's not a pleasant topic to discuss, and many people postpone those discussions until events force a conclusion. By far, the most frequent source of a referral is in the months leading up to an individual needing care. It becomes clear to the person going into care, it becomes clear to their spouse, it becomes clear to the family that the individual concerned cannot continue to live by themselves. And at that point in time, or care for themselves, and at that point in time, we might be contacted to see what can be done. And the third group, and this is they're not a large number, but it would be the second in volume, would be whilst people are in care. And that might well be where someone's gone into care, they don't qualify for funding from the state, so they're paying for their own care, but during their stay, one of two things happens. Either one, they start to erode their assets faster than anticipated, and they become concerned what will happen if they run out of money. Or two, which is perhaps a more frequent, is their own situation deteriorates, and they move from being a self-funder to a state-funded person because of their particular circumstances. We often get asked, well, how long will someone be in care? And statistics issued by the Office of National Statistics indicate that for people aged between, this is females aged between 65 and 69, the average period in care would be 7 years, and 2.9 years for a lady aged 90 and over. For males, the average time in care between 60 and 65 is 6.3 years, and at 90, it's 2.2. If you look at a general average across the board, it's between 3 and 4 years. So you can spend a considerable amount of money or erode or use up a considerable amount of your estate over that time frame. And so preparation, planning can give you the reassurance to know that you can afford care, or the reassurance of knowing that you're protecting assets as much as possible for the benefit of your surviving spouse, but also your family. Cost of care, we've got a list there, and these are averages. My experience at the moment is certainly in the southeast, southwest of England, you're probably looking for a nursing home somewhere in the order of £800 a week, a residential home, £800 a week. For a nursing home, you're easily looking at £1,200 a week for a cost of care. And we will talk later about the impact of the changes in being introduced in 2025, whereby there's a cap on what you might be expected to contribute to your own care costs. And that figure at the moment is £86,000, but we will see that there are some caveats to that, which makes it look far less generous and more onerous than you might otherwise first think. the routes to care, from experience, come from one of these areas. You get crisis arrivals from hospital discharge, accidents or frailty. It says there as well, fertility. And the benefit, the reason for that is, it's happened with my own parents. My father died at age 84, and we realised before he died that Mum would not be able to continue to live by herself should he die first. And within a short space of my father passing, we moved Mum into a care home because she just wasn't capable of looking after herself. There's eligibility assessments. This is where either family or local medical practitioners identify that an individual is not able to care for themselves and makes a suitable referral. And the community care aspect comes in as well. By far the largest source from our perspective of the people we do is people are self-referring. So the family recognise that mum or dad no longer can care for themselves, and so start making their own inquiries as to what the options are, what the costs might be, and what will happen to the family finances if one or both of the parents should go into care. This is a light-hearted chart. We're not going to talk through that. It is a complicated area, and there are lots of sources that you might refer to. We, in preparation for this seminar, Googled long-term care on the internet and came up with 7.8 billion references. That's not references to the word long-term care, but those are individual postings, access sites, information sites. It is a very, very complicated area. And consequently, it is not unusual for people to want help or guidance in order that they can sort of navigate through the care system. We work, at St James's Place, work with a company called Care Concierge. This is a paid-for service, but effectively you can, through ourselves, be introduced to Care Concierge, and they will help individuals or families make an assessment of their care requirements, highlight what assistance is already available from the government or from local authorities in regard to payments like attendance allowance and things like this, and then help suggest where a suitable care home might be close to your location. And so care homes some will be, as I say, it's a residential home, some care homes are specialised in dementia, and others in different sort of conditions, and that will enable you to get somewhere where you've got the most amount of experience from the people that are caring for you. And so again, this can be picked up at any point in time. It can be picked up ahead of going into care. It could be picked up when someone's already in care and wants a review as to say, actually, has my situation changed? Do I now move from a self-funder to a funded resident? And Care Concierge can provide the support, information, the backup that will help you in any application. I'll leave that for you. There's two people that have used Care Concierge, and it was a reference to what they thought of the quality and the benefit of doing that. And through Lester Brunt, through your advisor, through myself, we can also work alongside you and Care Concierge to ensure that you get the most appropriate assistance for your requirements. Who pays for care, at the end of the day, is a means-tested arrangement. And if you have assets above £23,250, then you'll be expected to pay for your own care. Now, where might that money come from? If you have a state pension and you're going into care, then the local authority will assess all of your state pension. If you have a private pension and are going into care, then the general rule is that they would assess 50% of a private pension. So not only can the financial burden be heavy for the person that is going into care, the person that remains not in care but living at home can find that their own income is diminished because they've lost the state pension of the person that's gone into care, and they're only going to receive half of an occupational pension that might otherwise have been going into the family finances in order to cover their day-to-day living costs. There are two funding options that might apply. One is continuing care. This is where the local authority assess that you have a medical need, and that medical need can be served and met by the NHS, and in those circumstances your care costs are fully funded. If you don't quite qualify for continuing care, there is funded nursing care, and that means that you've been assessed as needing a registered nurse looking after you in a care home, and for the 23-24 tax year, the funded nursing care is £219.71 per week. What does that mean? In effect, it means all the resident is left to do is to fund their, what we refer to as their hotel costs. That's the room, that's the provision of food, 3 meals a day, that's the heat and light in the building. It's all those things that you might otherwise pay for at home. You would be paying for yourself, but your nursing care would be met by the government, and so that would give some support to the costs that you're paying. Whilst you're in care, you may also qualify for attendance allowance, and so consequently the upper limit is currently £101.75 and the lower limit is £68.10. So someone that qualified for the upper attendance allowance and the funded nursing care would be receiving a little over £320 per week towards their care costs. And that would leave the shortfall, and depending on the home and the cost of your area, that would be the figure that we'd be trying to cover for you. When we look at assessable assets, the rules are clear but confusing. So if you have cash in a bank or building society, that is accounted. If you have ISAs or unit trusts, that's counted. If you have property, that is counted in certain circumstances. Certainly if you have a second property, that would be counted. If we're talking about your main residence, if you have dependent children, and for this, dependent children are individuals aged under 18 or individuals aged over 60, or your spouse continues to live in the property, then your property is disregarded. In all circumstances for care, property is disregarded for the first 12 weeks. However, there are certain assets that are not assessable, and the most common of those would be investments you may be familiar with called investment bonds. An investment bond is technically a non-qualifying whole-of-life assurance policy. So it is set up under the terms of life assurance policies, and it's done that way because it gives certain tax advantages for you as an investor if you invest money in during your lifetime. But the life assurance element that is crucial to distinguishing an investment bond from different types of investment means that someone going into care would not have that investment taken into account. However, any regular withdrawals that were taken from the investment would be included in any assessment as to what contribution a person going into care might need. So if we give you an example, if I need to go into care, and let's just imagine two circumstances. Let's imagine in the first circumstance, my assets are below £23,250, and so I'm going to qualify for some form of state support. My care needs will be assessed, and the cost of those care needs will be assessed, and then we will have what the cost is, and then they will look at my income. As I've mentioned, they will take account of all of my state pension. They would take account of half of any personal pension that I have, and any other income that is in my name would be assessed. That income, less a payment of about £24–25, would be used towards my care costs. So if the local authority deemed that the cost of my care was going to be £800 a week, but when you looked at my state pension and my personal pension and any other income that I had, including regular payments out of an investment bond, that income would be totalled up. I'd be allowed this £24–25 as a personal expense allowance, and the balance would be used to pay the first portion of care, and the local authority would pick up the shortfall. If my assets were over £23,250, then I would be expected to pay for all of my care until such time as my assets drop below that figure. There is a lower threshold figure of £14,250, and for someone with assets between £14,250 and £23,250, there's what we call a tariff income. And that is an assumed £1 a week of income for every £250 of assets held between those two figures. So for argument's sake, someone having assets of £16,250 would be deemed to have £2,000 above the lower threshold. £2,000 is 8 lots of £250, and so I would be expected to pay £8 of additional payments from my capital per week to cover my care costs. There are rules around deliberate deprivation, and the precise interpretation of that is often down to the individual local authority. But deliberate deprivation means you cannot take steps to deliberately remove assets out of your estate with the express intention of reducing or avoiding care costs. However, in our day-to-day dealings with clients, we often come across circumstances where sensible planning will assist a family that might have someone going to care, and would not fall foul of the deliberate deprivation rules. I've made reference to the fact that you might want to review the will of someone going into care, or the person that stays at home not going into care. It is not deemed to be deliberate deprivation if I am in care and Alison, my wife, amends her will to perhaps leave her estate either in a trust or to the children, but not directly to myself, in order to avoid my assets growing that are just going to be taken and eroded in care costs. Also, if talking to a client about how they may invest their monies, whether that be cash or unit trusts or ISAs, the option of an investment bond is a very sensible option for many people to consider. The fact that holding money in that investment bond will exclude it from assessment in assessable assets is not deliberate deprivation, providing we can justify the reason for making the investment in the way that we have. And over many, many years, we have invested monies on behalf of clients in investment bonds, which have provided an attractive investment to the client, but have also given reassurance that if someone falls into care, then knows that capital is unlikely to be assessed. We will more often get called to a meeting when there's a shortfall. So we have a client going into care, and we're just going to imagine this client has got a care cost of £1,000 a week. And when we look at their state pension and their other income, their income is £500 a week. And so we have a £500 a week shortfall that we need to try and provide, or help guide a client how to provide that. And our intention would be to try and maintain the value of capital assets so that the client knows that they can stay in care for as long as needed and they're never going to be short of assets. One of the things that have been introduced through changes in assessment is deferred payment. This is not offered by all local authorities, but where it is offered, a deferred payment scheme means the local authority will pick up the cost, but they will put a charge on the family home. And when the family home is sold, either because the person in care has died and they're the sole owner, or the person that wasn't in care but was living at home dies and that house is sold, then the first item to be cleared from the sale proceeds of the house would be the value of the care provided by the local authority, which has been secured against the house. There is also the option of renting the property out. We have equity release. These are referred to as lifetime mortgages. And this is where a property is valued and a sum of money is released against the value of the property and the age of the property owners. So the older you are and the more valuable your house is, there's a larger amount of money that you'll get. We will sometimes look at how we might otherwise hold cash. Up until 12 months ago, cash investments were relatively unattractive as an investment form with interest rates at below 1%. That has now changed over the last 12 months and cash deposit rates of between 4 and 5% are available. And it may well be that managing money in cash and looking to maximise the returns will be sufficient to cover a shortfall. Using existing investments in combination with other aspects above can also be a way to meet that shortfall. You've then got care fee annuities. An annuity is a pension. It is a fixed income or a guaranteed income. It may be fixed, it may not. A guaranteed income that you purchase for a sum of capital. And the benefit of a care fee annuity is if that payment is paid directly to the care home, it is not subject to income tax in the hands of the person in care. And then the final one there is got family contributions. And we see that increasingly where members of the family will support the person in care because they want to try and preserve the family assets and they don't want the assets run down from higher fees, fees that are higher than the assets can support, and they feel a better way of doing that is to meet some of those payments out of their own regular income. If we just look at each of those in turn for the moment and look at the pros and cons of each, if we look at the deferred payment scheme, it keeps the property in the estate. So that's a benefit. So in other words, for the surviving spouse, they can continue to live in that property. For the family that may want to eventually inherit that property, because there's a reason for that, it's deemed to be a family heirloom, there's an emotional reason why someone would like to retain in a house. So the deferred payment scheme allows that to happen because when the resident has died, whilst the money that's accrued on the property has to be cleared, that might be done by way of a remortgage as opposed to a house sale. So it gives you a little bit more control over what happens to the family home, and if it's an asset that wants to be retained by the next generation, that can be done. There is no interest charge at point of contact there with the deferred payment scheme. Whilst interest is accrued, you're not having to pay that on an ongoing basis. You also benefit from any increases in property value. So consequently, if the house is it's certainly in the south of England, where in recent years house prices have been very strong, you have the ability to maintain an asset that might be growing in value faster than the cost of care. So it makes financial sense in order to retain the property. And finally, it also allows the property to be rented out. However, that rent would be subject to income tax and would be assessed against the property owner, i.e. the person that's in care. What's against that, as I said, not every local authority makes this scheme available, and so therefore you may not be able to get agreement. There's no safety net. The debt continues to grow, and therefore it is possible that the debt could grow to be greater than the house is worth. That would probably require a long-term stay in a care home, but it is not out of the question. And ultimately, the property might have to be sold in order to repay the debt when the resident dies. Renting the property out, the big pro for that, the big benefit of that, is it makes the asset work for you. You benefit from the house price increases, but as I've said, the rental income that you will receive will be subject to income tax. Against, there might be periods when the property is not let out. You've got maintenance costs, and we've got their tenant troubles. My experience with clients of renting properties out is that you're deemed to be the landlord, and the tenant, you're the first point of contact if there's any issues with the property. And that may just increase your burden of looking after the property, and may just mean to be an unnecessary additional commitment. And the net returns may not be great. The average residential rent return is between 3 and 4% as a guideline. So it's not a great return, but again, it is something to look at. Equity release, as I've mentioned, that's a loan, and there's a whole range of providers now that provide these equity release loans. They come with a bit of a tainted history, but the modern interpretation of equity release is much sounder and much more acceptable. As we've said, you benefit from increases in property value. An assessment will be made about the age of someone and the value of the property. As a typical guideline, a person aged 70 could look to raise between 30 and 40% of a house value with the ability to make no repayments during their lifetime. And it makes capital available. What's against this is not all equity release companies will make this loan available if the owner is in care. So if my wife stays at home, I go into care, we're deemed to be a self-funder, an equity release scheme will work. Because it will be taken out in joint names, my wife lives at home, that would meet the criteria. If my wife predeceased me, then it may well be then that the equity release company would ask for the property to be sold and for the loan to be cleared. Interest is charged, it can be accumulated, and that can then erode equity in the property for beneficiaries. Not that I see why you would do this, but it is possible to meet the interest, and this may be where family might help. So it may well be a contribution from the family would be to cover the interest that is accruing on an equity release loan, so that that debt doesn't get bigger and doesn't erode equity that will come to the family ultimately, but makes the equity release loan a more attractive option. It's a debt accrual, so it's creating a debt, and generally in later life, many people want to be debt-free rather than starting a new facility to borrow money. And it says they often have to sell property to repay the debt. That is obviously the last resort, but without question, there are other options. The debt does have to be cleared, but the equity release mortgage could be converted to a standard repayment mortgage in the names of one of the ultimate beneficiaries, if that is something that's attractive. Or even as a buy-to-let, if it may be the family want to keep the house to rent it out in the future, then that equity release mortgage could be cleared by a buy-to-let mortgage, which will provide the ability to keep the property and repay the debt as necessary. Assets into cash. Well, if it's cash, it's low risk, it's accessible. So that, for many people, is an important factor. However, the returns are low, and I would say low relative to inflation. So if you look At where we are now, you can get, as I said, interest rates at 5%. I noticed, I heard on the radio this morning that 2-year government debt is costing 4.5% for the government to borrow money over a 2-year time frame. You can get deposit accounts for a fixed 12-month period paying just under 5%. That's attractive, but if you've got inflation at 8.7%, then you're still going backwards. And the increase in costs for care homes has been quite substantial over recent years. You've only got to think of the increase in costs of fuel and imagine if you've been into a care home and warm those environments are, that their expenses have gone up quite significantly. And in that sense, if inflation is greater than the returns you're getting, you've got this capital depreciation. Using investments, and that is an increasing area that we see, it makes the capital work harder for you, and it could create more income than cash. So therefore, you can get better returns, but we've seen over the last 2 or 3 years, we've seen with COVID, we've seen with the Ukraine war, that stock markets have been quite volatile. So there's probably not one simple solution, but it's a combination of what you might do in order to cover the income required for someone in care. What goes against using investments, returns are less well known, volatility. Volatility in market prices means that you're having to sell more of your assets one month than another because prices have gone down in order to draw out the money you need to make the payment. And that can accelerate the erosion of your capital. Care fee annuities are, as I've said, when you buy effectively, you're buying a fixed income. So an assessment is made of the annuitant, their age and health is taken into account, and you can approach a range of companies and they will give you a quotation of how much income they will give you for a given sum of money. That income could be a fixed payment, so it's level for the rest of the annuity, or it could be a rising payment. The more sophistication you add to the income, then obviously the greater the amount of capital you have to give up for each pound that you're receiving. But what it does do is it gives you certainty. And in many circumstances, we talk to clients about meeting a portion of their care costs through an annuity and topping up any shortfall either by family contributions or by other assets that the person in care has. The annuity helps protect the remaining capital. It's a tax-free income because, as I've said, if the annuity payment is made directly to the care home, so let's just imagine my care fees are £800 a week and I have an annuity that is £800 a week. It will go direct to the care home. That settles my costs. The care home will pay tax on that, but that doesn't count as income in my hands. So I'm not having to pay any kind of income tax on that payment. What goes against the annuity? There are periods of protection, but these are relatively short periods. So consequently, I've paid out a sum of money to buy a fixed income and I die 12 months later. The income payment stopped because I'm no longer alive, but my family, my estate has lost access to that capital. And that becomes a concern both for the person going into care and also for the family because we don't know how long we're going to be in care. And we become concerned about, well, I'm going to pay over a significant sum of money and mum or dad might only get that payment for 6 or 9 months. And if it's a level term annuity or even a rising annuity, it may not meet or match the increase in fees. And in order to address that situation, we would generally, as a rule, recommend a level annuity and we look at the increases, the cost of living increases that happen to care fees to be met from other resources. And that gives the most flexibility. The family contributions, we've talked about these. The benefits of that: there's no erosion of assets. It's generally interest-free, but it doesn't have to be interest-free. So if you've got someone in care that may have an estate liable to inheritance tax, there is nothing to stop the family making payments and charging interest. That interest, though, would be subject to income tax, but you could do that. It removes worries from the person in care. In reality, my experience of that is that the person in care often becomes detached from the cost of their care. So they make an assumption that the care costs will be paid for the rest of their life. They're going to be in their home for the rest of their life. And how that's paid for, what assets get used, what the effect on the estate, in most circumstances, does not become a concern or a worry for the person in care. It can top up the annuity payment. And finally, it says it can be a gift or a loan. The loan benefit can be very interesting for inheritance tax. So you can, if you're making a payment on behalf of a relative, that payment will need to be repaid to you at some point in time, and that could reduce the estate and bring it below inheritance tax. And so therefore you can make a tax saving that ultimately is to the benefit of the beneficiaries. What goes against family contributions? It can't be the person in care. It has to be someone else, and it's an unknown time frame. So you may be in care, someone may be in care for a long time, and obviously if you can't afford to make that, you can stop your contributions, but then the person in care may find they've got to move home. And that contribution can be significant. So it's not something to be entered into lightly, but in some family circumstances, it becomes a very workable solution. As I started off by saying, the system that we have now has arisen over a number of years, and whilst everybody recognises it's a system that's not fit for purpose, what's not so easily recognised is what's the alternative. And Boris Johnson, in this 2014 review, suggested that there would be a cap on what people would contribute to their own care fees. And knowing what that cap is enables families to plan and know what might happen should one of their loved ones go into care. Now those changes were to be introduced in the past. They've been delayed, and the latest date now is October 2025. I think the thing to really highlight, which is what I referred to a little earlier, is the cap is £86,000. However, someone that's in care now, whatever they're paying, does not contribute to that cap. So if this is introduced in October 2025, the cap starts from then. So it's £86,000 from October 2025. And what contributes towards the £86,000 is not the cost of care. It's not what you pay on a weekly basis. It's what is deemed to be the medical element of your care provision. So the hotel costs that I've referred to earlier, the fact you've got gas, electricity, rates, the fact that you've got 3 meals a day, laundry services, you've got staff keeping the home clean, those hotel costs are not part of the £86,000 of assessment. If you look at what funded nursing care was, that was, I think, £219 a week. It doesn't take much of a calculation to realise that someone could be in care for many, many years and not reach an £86,000 limit. So whilst on the surface it would seem, well, actually, my estate is worth £500,000. The most I've ever got to pay is £86,000. I know I can leave at least £400,000 to my family, is not the situation that you'll be facing. And in fact, an £86,000 of care fee could result in someone spending in the order of £400,000 of their estate altogether. So these rules, it's not enforced at the moment, it's not enacted, there may be changes, but it's not the solution that was first painted, saying that you won't have to sell the family home, you'll be able to pass the family home on to the next generation. That may not be the case. And so therefore, how you hold and manage your assets may become more important and forms the basis of many of the conversations that we have with clients regarding everything surrounding long-term care. The threshold for this will be different. As we stand at the moment, in England, the threshold is assets below £14,250 and the local authority pays for your care. Assets above £23,250 and the resident pays for all of their care. And for individuals with assets between those two figures, the care is paid for, but there's a contribution of £1 per week for every £250 of asset between those two figures. The suggestion is that that minimum of £14,250 will be increased to £20,000. So someone with assets, assessable assets below £20,000 will have their care paid for with the local authority. The upper limit will be £100,000. So that moves from £23,250 to £100,000. So therefore, there will still be this tariff income for people with assets between £20,000 and £100,000. But the threshold would increase to £100,000. So if you have over £100,000 of assets, you'll be responsible for your own care costs. Again, when you look at the area in the south of England, it's hard to imagine a property owner having assets below £100,000. Purely because of the house itself. So if the house falls for assessment for whatever reason, then it's likely that even then you would exceed the threshold and be responsible for your own care costs. I'm coming towards the end of the presentation now, and really it's to summarise that we spend a lot of time working together with clients. Working out what's the best way of helping fund for long-term care, to plan for that, to get the right home, to get the right protection, to make sure that you are claiming all the appropriate benefits, and then helping to understand how we can protect assets going to the next generation. We'll give guidance in regard to the writing and preservation of wills and powers of attorney. And the important aspect about powers of attorney, if you've issued a power of attorney where the instruction is a joint instruction, so I'm saying to my 3 daughters, they must act jointly, that means all 3 of my daughters must agree to what goes on. If one of those 3 daughters should lose mental capacity, then the remaining 2 would have to approach the Court of Protection in order for them to operate the power of attorney, because you can't have 2 out of 3 attorneys agreeing. So with a joint mandate, all people have to have capacity. If you have a joint and several, which means any one individual can act unilaterally, that overcomes that situation. So these are the sorts of, if you like, wrinkles that you need to be aware of, that our experience will enable you to get the best possible guidance about what it is for you and your family. And we will help. We've helped clients in the past where someone has been in care, they've paid for their own care, it has been realised that actually they should have qualified for local authority support, and even after the resident has passed away, we've been able to assist in getting money paid back to the family because care had been paid for when it wasn't the responsibility of the person in care. So those are the areas where we can help. It starts with a conversation. And although it's a difficult conversation, it is one where you benefit from starting that conversation sooner rather than later. So if I thought I had the prospect of going into care, I would want to try and be involved in making the choice of where I might go into care. That can only be done if you start that preparation early enough. And in most circumstances, people going into care are as a result of a gradual deterioration. It's not a lightning bolt. It's not I was fine yesterday, but I'm not fine today. Of course, that happens. It's not the general rule. So there is the opportunity to recognise something might be needed and to make enquiries to see what is the options for me and what help can I receive. St James's Place have produced a brochure, Paying for Care in England, and it's very similar to Scotland and Wales, but there are some differences with the allowances and the amounts, and we could provide that for clients that are looking at care for people that are either resident in Scotland or resident in Wales. But this brochure, Paying for Care, it's very much summarises what we've talked about today. So if you'd like a copy of that brochure, we'd be very happy to provide. And again, if that would form the basis of a discussion about how these things might work for you, that would be something that I think would be mutually beneficial. Thank you for your time. We really appreciate your feedback on the seminar today. And if you could scan that barcode by opening your phone, camera on your phone, taking a photo and completing the link, that'd be really helpful. Please remember, you can speak to the advisor. I'm happy to work with you all, as I've said in the past. Your first point of contact will be with the advisor you regularly work with. And if you've told them, look, if you attended this seminar, we'd like to get a bit more information, can Michael get involved? We can work that out. But they are your first point of contact because they're the people that will help you, along with my help, to also put that in place. And if there's any questions, I'll be very happy to take any questions.
Yeah, thanks, Michael. Could I ask a question about something you were saying about wills?
Yep.
So a situation as follows: one spouse is in a care home.
Yep.
The other spouse is to live in a family home, which cannot be be used as an assessment against costs because they are the spouse living in the family home.
Yes.
Would sensible planning, as you called it, I think you called it, allow you to have a will for the person who is living in the family home, where on their death, the property is then left to the children, so that effectively the protected from being used to be gobbled up for care home costs? Would that be considered deliberate deprivation, or would that be considered sensible planning?
I think that would be considered sensible planning, and it's something we've done on a regular basis. The thing you have to recognise is, in order to do that, the property, there's two ways of owning a property. You're either joint tenants or you're tenants in common. If you are joint tenants, ownership of the property passes automatically to the other joint tenant, irrespective of what a will might say. So if I own my house as a joint tenant with my wife, I'm in care, my wife predeceases me, I automatically inherit her share of the house. If, however, I convert to a tenancy in common, it means that each of us owns a given percentage. Now, that given percentage might be 50-50, or there may be reasons as to why it's not 50-50. It doesn't have to be that. But being a tenant in common, I'm in care, my wife could write her will in the way that you've just said. She could say, on my death, I leave my share of the family home to my children or grandchildren. Remember, for the residence nil rate band, that additional £175,000 of inheritance tax allowance, property has to be left either to a spouse or a bloodline dependent or an adopted child in order to claim that allowance. So my wife amending her will to leave her share of the house directly to our children or grandchildren would preserve both its IHT efficiency as well as meaning that I don't inherit her share of the house, and therefore my assets are less than they might otherwise be.
Okay, so tenancy in common still means that there would be a percentage, and it could be 50% or it could be less than 50%, that would
Indeed.
therefore pass to the person who is still alive but in care, and therefore become
No. If it's tenancy in common, then it's controlled by the will. So if I'm a tenant in common with my wife, and my wife dies and she hasn't got a will, then in regard to the house, she's died intestate. So it's only joint tenancy. With a joint tenancy, if I've got no will at all, I'm a joint tenant with my wife, I die, my share of the house passes automatically to my wife. So what we would do in that planning situation, we would make sure that the house was held as tenants in common, and then make sure that the will left the share of the house in the right way in order to protect both the person in care and the remaining family.
Okay, thanks.
It's a pleasure.
Can I just ask about the power of attorney
Yes.
related to health and welfare?
Yep.
I have one for my wealth and assets. What's the downside risk of not having a health and welfare power of attorney?
Okay, I think there are two aspects that cause concern, and these are mainly to do with the person given the authority, if that makes sense. So the one is, I want to make sure that someone can choose the home I go into. I don't want the local authority saying, look, Michael, you need to go into a home. You haven't got, there's no health and welfare. We will decide what home you're going into. So they want the reassurance that my family, the people I trust and love, will have this deciding choice in which home I go into. And also in regard to hospital treatment and end-of-life hospital treatment, a sort of a do not resuscitate instruction. Health and welfare enables you to give to someone the authority to say, I know that Michael explained to me that, you know, if he has a terrible stroke or whatever, you know, and he's brain dead or whatever, please do not resuscitate him. So I think it's a burden that you put on someone else, but the benefit is, you know, that if anything dread should happen to you, that there's people you love and trust and know your wishes can carry out your wishes.
Okay, I mean, if one of the couple are still well and able, then that's not a risk, is it? It's only in the event of one remaining person?
Well, it's not quite. What happens is, if you've got a married couple and one goes in, the hospital or whatever may well, or the local authority may well listen to the spouse, but they're not obliged to follow.
Okay.
Okay, so again, going back to my own parents, my father, at the end of his life, he hadn't issued a health and welfare. It wasn't available then when he died. But the hospital talked to myself and my brother about what we recommend, what treatment we do and what treatment we don't do. And we made a decision as a family, which the hospital had sort of recommended and were happy to put into place. If we'd have wanted to instigate that ourselves without that health and welfare, the hospital could have ignored it. They could have just said, no, our view is this. And so what that health and welfare power of attorney does is give a greater amount of authority to the family, saying, I'm now speaking on behalf of the person you're treating. And I know their wishes, and this is what we want you to do, please.
Okay, thank you for that.
I would support what you just said there, Michael. I've got personal experience of mother-in-law who's still alive but got severe dementia. My wife, does everything for her, and we were advised some little while ago that you need the financial POA, but don't worry about the health and welfare one. Yeah. And now she needs various operations and things, and getting the doctors to agree that they will listen to what my wife says, because she's got her full medical history, but because they can't get the information out of my mother-in-law because she doesn't understand what they're asking.
No.
So I put from personal experience, I wish now we hadn't accepted the suggestion that we didn't need it. I think the answer is yes, you do. Because you
can go to the court of protection, but it's slow and it's expensive.
Exactly. Yeah.
So it's not impossible, but it's just, at a time of stress and worry and concern for everyone, it's just an unnecessary additional step.
Michael, coming back to the point about tenants in common or joint ownership, whichever you have, are you saying that if one of you goes into care but the other is still in the house, then that house is not taken into consideration?
Correct.
So all the sort of the issues that you were talking about later were about where a house effectively is being left empty by the surviving.
Yes. So yes. So whether you're a joint tenant or tenant in common, the house is ignored if one of the couple or a dependent child lives in that property. The worry that I've tried to highlight is we all imagine perhaps the person in care is bound to be the first person that passes. The healthy person living by themselves, they'll be fine, but it's not always the case. And so you just want to make sure that should the healthy person pass away first, that situation doesn't have an adverse financial implication because assets have been passed. And if you wanted to make sure, as an example, you wanted to make sure that the person in care could benefit from the assets but weren't going to be assessed by them, it may well be that assets were left into a trust. So that on first death, the person that dies first may leave assets into a trust. And if it's a discretionary trust, the person in care could be a potential beneficiary, but they're not they're not a guaranteed beneficiary. And so the assets of that trust would not be accessible for their long-term care. So it's about giving the family and the individuals concerned the most amount of control.
So I currently live on my own, and I have 4 boys, and I have young onset Alzheimer's. Can I leave my house already in trust for my children so that it's not considered as part of my assets?
Yes, you can. It depends on the value of your property, but yes, you can. So, and this is, we've done that arrangement for clients. So how do we address deliberate deprivation?
Mm-hmm.
Someone would say, well, why has Michael put his house into a trust?
Yeah.
When he's not, there's no one else, so he's not married, there's no one else. So what is the possible legitimate reason for Michael putting his house into trust? One reason that you might use is to avoid probate delays. So if I die, I'm the sole house owner. Before that house can get passed to anyone, my estate has to go through probate.
Yeah.
And probate is the process whereby assets in my name are identified and reported to the Inland Revenue, whether tax is payable or not, in order that they can then be dealt with according to the terms of my will. If I was to put my house into a trust and I'm a beneficiary of that trust, it has no impact for inheritance tax. So it's not an inheritance tax scheme because I'm a beneficiary of that trust. But what it does mean is I can continue to live in the property. It continues to be my property. It continues to be my principal private residence. So why have I done that? It's because when I pass, that asset belongs to the trust and the new owners are the next group of beneficiaries. And the trust might be with myself and my 3 daughters as trustees. I put the house in the trust. When I die, the 3 daughters would continue as trustees and they could decide to sell the house or keep the house or rent the house out. They could do whatever they wish without any delay caused by probate because the asset in that house is not subject to probate.
And that would therefore protect it, the house value, from any repair costs that I would have incurred. Yes.
Yeah. And it's all about the value and there may be other things that you could look to do that was probably not for the seminar now, but for an example, many years ago, I helped a lady that lived with her mother. She was the sole beneficiary of her mum's estate. She was never going to own her own house, and she was concerned about 2 things: that way unnecessary inheritance tax would be triggered on mum's death, and also that if mum was to go into care, that she might lose the house that she was going to rely on. If there are circumstances whereby you can add a new owner to a house. So in this situation, the mum added the daughter as an owner to the property. They owned the property on an equal basis. They shared equally the costs and maintenance of the property. And the Inland Revenue accepted that arrangement as being a valid gift. And so what that meant was that going forward, the mum and the daughter were deemed to be equal owners of the property. So consequently, when mum died, she was only assessed on half of the house value because the daughter owned the other half. And mum didn't go into care, but if she had gone into care, again, mum would have only owned half of the property, and that would have had a significant impact on valuations, which would have meant she would more likely qualified for assistance for care costs.
My mother suffered a stroke earlier on in the year and has come out of hospital and is getting daycare in her own home. She lives on her own, as my father died some years ago. With the money that she has, she's got about over 23,000 odd. Yep. So we're currently just paying for that daily care from her savings.
Yeah.
When that gets down to a much lower figure, will she have to sell the house in order to continue to pay for that? And in other words, be forced into a care home?
Well, I don't think anyone's forced into a care home. So there might be two things. So can she continue to live by herself or with support coming on a regular basis? But in essence, the majority of the costs will be met by your mum. There will be some allowances she can claim, there will be some support that will be available. But if your mum is a house owner, then she's going to have assets above £23,250. And under the current regime, she would be expected to meet her own care costs. Now, it may well be, though, that at some time in the future, the decision is actually mum's recovered from the event that happened. And therefore, if she took action, she did some things that she thought was sensible, that would not be deemed to be deliberate deprivation.
I've got both powers of attorney that you talked about before.
Right.
So I'm in a position to be able to hopefully make some of those decisions for her,
right,
so that we don't end up in that situation.
What you have to remember, under a power of attorney, the financial power of attorney, you're not able to, and I'm not saying you will do this, but you're not able to give money away. You're not able to do anything that is not in the direct benefit of the person. So as long as your mum has got cognizance, then she can make, and you have a power of attorney that is operable, but she can still make independent decisions. So just as I'm not saying this is not advice, but just as an example.
Sure.
If your mum decided to put her house into a trust to avoid probate delays, she could do that if she's able to make that decision of her own free will. The fact that you've got a power of attorney doesn't preclude your mum from making independent decisions. If, however, your mum hasn't got capacity and she's relying on you to make those decisions, you can do that, and you could make a decision to sell the house or rent the house out or to apply for an extra lease mortgage. What you can't do is decide to put that house into a trust, because that would deem to be not something that would be in your mum's immediate best interest, because she's doing it to avoid probate delays. Your mum won't care about probate delays in the eyes of the court.
Yes. Roger.
Yeah.
Okay, understood.
Any other questions?
Your brochure, does it have some, shall we say, crib notes in it so that we can think about what we want to do
Yes.
as a starter for 10?
Yes.
Yeah.
Yes, it does. And also, if you had a copy of this recording, the two things together hopefully would be an aid memoir. The thing for anyone that's attended today, you could pick up the phone tomorrow and say, look, you mentioned this, could you just tell me, could we go over this again, please? I sort of understood it, but I'm not sure if I did. The idea of what we're doing today is an introduction to this topic. It's a complicated area. You wouldn't be expected to grasp it all in one sitting. if you want to dissect it in bite-sized chunks and say, what is sensible for me to consider? What is sensible for my family to consider? What are my options? We are happy to talk those through with you. And as those that have worked with us in the past know, there is no cost to you in making those inquiries. There may be a cost if you do something, or we need to rewrite a will. We can make an introduction to a solicitor. We can work with your solicitor. They might charge for the new will, but you're not going to get charged by us for giving you the advice or the guidance.
I understand that, and it's very useful in that respect. Yes, I think it's been a very useful exercise certainly for me. And thank you very much.
I might have missed this because I was a couple of minutes late, but you spoke about the numbers of people that, or rather the time frame that people typically go into care. But do you have a figure for the number of people in general, a percentage of people that do go into a care home at the end of life, rather than not? Because I mean, you know, we've lost all 4 of our parents, and none of them ended up in a care home, fortunately for us.
No.
And I just wonder what the figure was nationally. Do you have that?
I don't, but what I can tell you is in the 2022 to 2023, I think it was 360,000 people were in residential care in England. So,
okay.
and that used up, I think, 78% of the beds. So the good news is, and it is good news, the vast majority of people do not go into care. But if someone close to you does go into care, the consequences can be significant. I mean, my own mum went into care, as I mentioned. She would have been mortified to know that she was paying £850 a week to live in a care home where someone else in the room next door, paid for by the local authority, was only paying £525. So she'd have been mortified that she spent £850 for her accommodation, and further mortified to think that it wasn't a fair system, that someone else getting exactly the same treatment was paying 60% of that because it's paid for by the local authority. So it's to recognise that most people don't need care. On the basis we don't know what's going to happen, it's sometimes say, well, if this was to happen, what would our approach be? What would we want to achieve? What would the outcome we want for our loved ones?
Yeah, of course. Yeah, thanks very much. Thanks.
Okay.
Are the parameters that you discussed, the financial kind of parameters of when you pay and how much you pay, do they apply the same for if you're living in your own home as the sole owner and you need care in the home, or you want to organise care in the home? Does the financial equation still include your house?
Yes, it would. Yes, it would include your house. And interesting, when I was doing research for this, it was saying, oh, if you're going to have a live-in carer, it's at least £15 an hour. My research has shown me that live-in carers cost more than going into a care home.
Yeah, that's what it seems to me.
Yeah, absolutely. So this idea of £15 an hour, I'd like to know where they're getting someone at £15 an hour, because I've not found that.
I can butt in, Michael, and let you know that my mother, who I was talking about earlier, she had a month of live-in care, and it was £1,800 a week in Chichester in West Sussex.
Yeah, that doesn't surprise me at all. So it's one of those urban myths, you with me? That, and the other thing as well, probably misleading from films where you've seen it, if you do have live-in care, it's a very regulated area, and the maximum, from my experience, is like 8-hour shifts. So if you've got 24-hour live-in care, you've got 3 different people every 24 hours. And so for the person receiving that care, they may get excellent treatment, but they are most likely not going to build any long-term relationships with the people, because it's a rotating door, if that makes sense. And it's not literally someone different every day, but you don't know who's coming in. It's provided by a care provider. They're qualified people doing a very good job, but you don't know who you're going to get. If you are in a care home, you do get used to the people look after you, and you do start to build relationships. And a lot of the modern care homes, I remember one of my favorite stories, a husband died, She didn't need care, but she didn't want to live by herself. So she volunteered to go into care. So she was paying for her own care. She had 2 daughters, and her 2 daughters used to say to me when I speak to them, how's your mum? Oh, she's really well. We can't just drop in and see mum these days. Oh, why is that? Well, she's never in. So we have to phone up to say, is mum in today, or is she out on a trip, or is she doing something? So a care home is not necessarily always going to be someone that is in any way impaired. It may be someone that actually just doesn't want to live by themselves.
Yeah. Okay, that's really helpful. Thank you.
My pleasure. If that's everything, we'll close. You've got our email contacts. If anyone has a question later, well, I should have asked that, please send an email. We will come back to you in the next 2 weeks with everything. Any other questions, do pick up the phone. And once again, thank one and all for making the effort to attend today. Thank you so much.